Good afternoon and welcome to our webinar today, January the 12th. And our webinar today will cover the subject of managing hidden risks, retirement plan fiduciary issues. Why a discretionary fiduciary is the answer. It's an awful long topic for a webinar, but you'll hear the facts and hopefully gain a lot of good information from our presenters today. And with that, our first presenter is Dave Chrestensen. Dave is Vice President, Wealth Relationship Advisor with First Financial Wealth Management. Dave joined First Financial Wealth Management in 2001 and currently serves as Vice President and Wealth Relationship Advisor, and he serves clients in the greater Cincinnati area. Mr. Chrestensen has more than 20 years of experience in the financial service industry and currently focuses on providing clients wealth management solutions, including financial planning, trust services, investment management, and retirement planning. Dave is also a former business owner, and as such understands the importance of selecting the right retirement plan in helping your company and employees achieve greater success. Our second presenter is Patty Stoll. Patty is also a Wealth Relationship Advisor with First Financial Bank, and Patty has serviced clients in the Dayton area since 1976, with the most recent 18 years focused on managing relationships of high net worth individuals and their families. Patty joined First Financial in 2009. And I believe we're going to start off with you today. Is that right, Patty?
That is correct.
Well, welcome, and thank you very much for taking the time to share this good information with our friends and clients out there.
Well, thank you for that introduction, Dave, and I appreciate Battelle Battelle for their part in offering this presentation. Before we get started with our presentation, I would like to take a moment to share with the audience a little information regarding First Financial Bank. Our corporate headquarters is located in downtown Cincinnati, and the Dayton regional office, however, is located in Kettering on Far Hills Avenue. First Financial Bank's strategic operating markets are in Ohio, Indiana, and Kentucky, and we have more than 130 banking centers, 18 of those banking centers right here in the Dayton market. First Financial Bank offers products and services through 3 business lines: commercial lending to include treasury management, retail, that's our banking centers, and wealth management. Wealth management currently manages about $2.5 billion across 4,100 accounts. Now, to get started, as Jack said, the title of our webcast today is Managing Hidden Risk, Why a Discretionary Fiduciary is the Answer. And the purpose of this webcast is to inform our audience of some changes being made by the Department of Labor. These changes will address the lack of transparency, and that is a term that you will hear throughout this presentation, but it will address the lack of transparency oftentimes found within retirement plans. And these 2 changes will have a significant impact on plan fiduciaries. The first compliance date is April the 1st of this year, just a couple of months away, and it places more responsibility on service providers. The second compliance date is May 31st, so just a month following, and it's for the purpose of making sure participants are better informed regarding the plan, their investment choices, and performance of their investments. Let's take a closer look at the dates and specifically what they mean. First of all, let's identify who service providers are. There are 4 key types of service providers. They are record keepers, they're investment advisors, they're limited fiduciary service providers, and they are discretionary trustees. So by April 1st, 2012, which is just a couple of months away, service providers must comply with full disclosure of the retirement plan. On April 1st, the compliance date that is established by the Department of Labor, service providers must be transparent in providing information regarding the retirement plans, fees, and services. Service providers must provide written disclosure of the plan or a plan summary. They must provide a description of services provided, which also can be found on Form 5500 that is completed at the end of each plan year. Service providers must document the compensation they receive from the plan, such as direct compensation from the plan and any indirect income, such as soft dollar costs or 12b1 fees from the mutual funds. Bottom line, all compensation must be disclosed. Service providers must disclose if they are providing fiduciary services and if those fiduciary services are limited or if they are discretionary services. Most business owners, and this is important, most business owners think they have full fiduciary services when they do not. And then last but not least, service providers must provide detailed information about the investments within the plan and the options that are available. And we will go into more detail about that later.
Heidi, could I ask you a question on that? Who are they required to give the disclosure to, and in what form must that disclosure be?
The information would be delivered to the business owner.
Okay, to the owner or plan sponsor?
That's correct.
Okay.
Yes.
And whose responsibility is it from that point to carry it to the participants? Is it the plan sponsor's responsibility?
Yes, it is.
Okay.
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 The next compliance date is May 31st. And that is exactly 60 days following the service provider compliance date of April the 1st. And that disclosure, the compliance date it relates to the participant fee disclosure. Keep in mind that most participants think the retirement plan is free to them, and of course it is not. So let's take a look at what the participant fee disclosure will need to provide to the participants. It needs to provide performance data on the funds within the plan. The performance data must be net returns after fees. So in other words, the return of the funds after all expenses are taken out of the fund. Performance data would also include the returns of the 1 year, the 5 year, and the 10-year performance. And if the fund is less than 10 years old, then it would be for the life of the fund itself. It also, the participant fee disclosure also needs to include benchmark information for performance comparison. So for example, let's say you've got an S&P 500 fund in the retirement plan, then the benchmark appropriate would be the S&P 500 performance. Also, what must be disclosed are any restrictions or other costs related to buying or selling a security. And an example might be a real estate fund where an exit might be hindered. Maybe there are certain entrance or exit dates within that fund. Fee and expense information must also be fully disclosed. For example, total annual operating expense of the fund has never been disclosed before. They didn't have to, but now they have to disclose the fees paid out of the fund. So, in the past, total annual operating expenses were not disclosed. Under the new fee disclosure rules, though, the total annual operating expense must be disclosed to the participants. And then also what must be disclosed are any shareholder type fees. And for the last 2 points, participants must have access to a separate website for additional information. And on that website, it must include a glossary of terms and concepts for the participants to access and to use. At this point, I'm going to turn it over to Dave, and Dave's going to share why this information is a main focus for the Department of Labor.
Okay, great. I want to take this opportunity. I think I failed to mention that we will again be offering CPE credit for this session, and the first CPE code is 751. Again, you should have received a form, and at the end of the session today, if you would email that back to the person indicated, and note the codes that I will give 2 more throughout the presentation. Dave, go ahead.
Thank you, Jack. And Patty, thank you for your efforts so far. What I'd like to talk to you now about is the Department of Labor focus. And why is this a focus of the Department of Labor? The first reason is that most plans today purport to comply with the Section 404C, participant-directed plans, and they do this in written terms, but many, many plans the Department of Labor have found in an operational perspective do not actually meet the 404C compliance issues. So these are serious issues, and they can create legal ramifications. Now, Section 404C, I won't bore you with the whole details of 404C, but it is a way for a business owner to, or plan fiduciary, I should say, to not be responsible for losses in a self-directed plan. Obviously, none of us as business owners want to be responsible if our employees invest and lose money, and that's what 404C is there, a safe harbor. Now, as a result of work that the Department of Labor has done on research work, what they have found is that there are a number of compliance and safe harbor issues that are not being addressed by the plans. The intent of the compliance and safe harbor issues is to have an explanation of the intent to comply. You are intending to comply with the rules so that you may be, as a fiduciary, relieved of liability. That's the purpose of 404C. It is also designed to give a description of what are called the designated investment alternatives. Under the new rules, however, these DIA objectives, which is what the Department of Labor calls them, provide certain things, the objective of the fund, but also the risk and return characteristics. Under the new regimen, it must identify the investment manager and have information on fees, transfers, limitations, penalties, adjustments, etc. Now, ERISA has been around since 1974, and these compliance issues are not new, but what is being done now is a complete codification of them and expansion to provide greater transparency. Again, that key word that Patty mentioned originally, and it is a huge thing now with the Department of Labor. They've added the fiduciary indemnification information as to whether or not you are in fact providing fiduciary services, and prospectus information before and immediately after investing, and rights on voting, tender, and other similar issues. Now, the rationale, and this is actually from a webcast that I attended with the Department of Labor September 13th of 2011. The rationale of the Department of Labor is transparency of fees. And this is their concept and idea. So what I've done is I've lifted these slides so that you can see exactly what they're saying relative to this issue. The participant level fee disclosure has to do with the Code of Federal Regulations. That 29 CFR 2550.404A-5 is 29 is the Department of Labor. That says that any retirement plans are under their purview, and CFR, of course, is the Code of Federal Regulations, for those of you who may not know. But they are fiduciary requirements for disclosure in any participant-directed individual comp plans. Since most businesses have gone to a 401k type of plan to supposedly take the fiduciary liability for investment losses off of their plate, that's the purpose of the Department of Labor's program that they're putting forth. To give you an idea, the background for that 404A compliance issue under the code that I just read, I'm going to read you just a portion of it, is that participants are to be made aware of their rights and responsibilities with respect to the investment of assets held in or contributed to their accounts and are provided sufficient information regarding the plan, including fees and expenses, and regarding designated investment alternatives, including fees and expenses attendant thereto, to make informed decisions with regard to the management of their individual accounts. What the Department of Labor has determined is that this has not been the case. There have been a number of lawsuits where funds have been found to not be disclosing, plans have not been disclosing, so that is the reason for the more stringent regulation. And as we know, more stringent regulation always leads to more stringent enforcement. The request for information, it started back in April of 2007 when the Department of Labor started to look into things to ask what is going on with these lawsuits that are starting to arise. Proposed rules were made by them in 2008. Final rule, of course, was in 2010, and then we had the delayed rule in July that moved things to the April and the May dates that we now have. There has been some talk in the past few weeks about the possibility of the DOL moving the date again, but we do not believe that the DOL will move the date as it gets closer and closer. But what we have here is a timeline for the Department of Labor's activities, which was all driven by lawsuits from people that were losing money and looking for opportunities to find out how could they recover some of that. Now, continuing that rationale, what the Department of Labor has said is that for the first time, they want workers to be able to receive core investment information in a comparative format. In the past, if you've had a plan, there has been no methodology for you to do any comparative analysis of the investments that are available to you. There has to be uniform investment information, regardless of what the investment products are. They're looking for an opportunity or a methodology to create apples-to-apples comparisons. And the Department of Labor has left this up to the individual plan sponsors as to how they will make this apples-to-apples comparisons. They have given some direction as to what it should look like, but it's up to the product manufacturer and the plan sponsors to come up with the actual methodology. What they're hoping to accomplish here, once more, when I was on the webcast, was a large conversation about fee transparency and transparency as it regards to comparative analysis. And finally, a quarterly statement that must show the fees that are actually deducted from their accounts. The single largest problem that the Department of Labor talked about was the fact that many participants, well in excess of 50% of the participants that were queried, and plan sponsors, believed that other than the administrative fees, the rest of the plan was actually free. So now what is going to happen is they're going to actually find out what fees were deducted from their accounts.
Let me interrupt just a minute. I realize we're having problems that the slides are not showing through properly. It's evidently stuck on our lead one. Most of you should have received all the slides. So as we go through there, we're currently on slide number 10. So the number 10 should be at the bottom of the slide that you received, and we'll work to hopefully resolve the issue with the right slides showing through. So sorry about that.
Oh, that's okay. That's okay. Well, we're on slide number 10. We're almost getting ready to go to slide 11. So I'll ding, and you can flip your page.
Okay.
The issue that the participants will start to receive these statements, they will be the statement for Q3. So participants will, in the early part of Q4, will now actually see the actual deductions from their accounts. And this is when we believe that the issue for you as a business owner will be magnified dramatically. When participants find out that their plans, in fact, are not free and they have been charged, oftentimes a significant amount of money is deducted against the return of their plan. Okay. I will go a ding, and we're on to the next slide. The basic legal premise on slide number 11. The key point when I was in attendance at the webcast in September was that each bullet here is a potential enforcement area for the Department of Labor. We've got the ERISA Section 404A and B. If the plan is participant directed, the plan administrator, who is a 316 fiduciary, must take steps on a regular periodic basis to provide sufficient information for the plan participants and the plan sponsor to understand the plan, the designated investment alternatives, in order to make informed decisions. What came away from that discussion was that the bullet may also be an area of potential litigation for disgruntled employees. The Department of Labor isn't sure, I'm not sure, but I can tell you that if I were a business owner out there, I would not want to find out. What I think is interesting, and there was also a discussion on the webcast, was the fact that this is a process. And what we gleaned from the conversation at the Department of Labor webcast is that the plan sponsor is always a fiduciary, but that there is a way for them to delegate a tremendous amount of that fiduciary liability as long as they follow the specific process promulgated by the Department of Labor. Okay, Jeff. We'd be going now to slide number 12, and that's recent trends in litigation. There are a number of surveys out, and if you were to Google fiduciary litigation, fiduciary lawsuits, you'll find that there are a number of ERISA compliance lawsuits out there already. There are also a number of law firms and providers out there that are offering courses on how to sue and how to defend under ERISA lawsuits. It's actually quite fascinating to Google that and then do a little bit of research. The suits were focused typically on securities fraud and questions about investment risk, governance, and prudence. But what's driving these things are the economic losses that people have seen over the last 8 to 10 years, and investment complexity, which is getting more and more, the complexity itself is getting deeper and deeper. But these are only a few reasons for the continued new rules and regulations. There's also the fact that the SEC and the DOL are both focusing on expanding the definition of planned fiduciaries. That's come back and forth several times. In fact, interestingly enough, I just yesterday got my copy of Investment News, and there's an article about fiduciary standards and liabilities about a gentleman that formed a multiple employer trust, purported to be a planned fiduciary, and the litigation now is going off against him, but it's also possibly going to erode into the plan sponsors, the actual business owners. So that's a key area, and it was just in the Investment News yesterday. What we understand is that plan sponsors and service providers are in the spotlight now as never before with regard to their investment processes, and it's due to evolving case law. Litigation claims are focusing on who is making the decisions regarding what the investments are, what investments are chosen, the due diligence, and other procedures that the decision makers use. People always look for an opportunity to benefit from changes in laws and see if they can improve their position. So as a plan sponsor, you must be aware of the fact that there are these pitfalls, and course corrections need to be, and if course corrections need to be made, obviously now is the time to do so.
First, I want to interject another CPE code. The second CPE code is 126. 126. And Dave, I have a question.
Yes.
Based upon the, ERISA you mentioned was 1974. And obviously at that time there were a lot of defined benefit plans, and certainly that was the birth of the 401k. And we've seen over the next 3 decades or so that 401ks have become the plan of choice for most companies. I guess the question I have is, has the DOL made an assessment in terms of the level of compliance that most companies have achieved Are they satisfied, or are they saying that, wait a minute, these companies are just not in compliance and not living up to the letter of the law in terms of providing the information to their plan participants and their employees?
That's an excellent question, Jack, and it was interesting. There were 3 presenters on the Department of Labor webcast, and they actually had a dialogue about exactly what you said. And the individual that was the, I guess, moderator of the presentation said, in reality, that is exactly what the Department of Labor has come to the conclusion, is that compliance has never been, it's not that it's fallen off, it never reached the level that it should have been. So we didn't see a falling off. We never got to the place because there was never any enforcement. So it's kind of like a guy falling out of a 90-story building and somebody hurt him as he went by the 50th floor. He said, so far so good. And realistically, I think that's what the Department of Labor is looking at and saying, it was an undertone was the fact that they haven't done their job in enforcement, and now all of a sudden they're going to change. They're going to change the. They're not changing the rules, but there's a new sheriff in town, so to speak.
I would also say that the level of sophistication of products out there have increased tremendously from the old balance forward product that was there where you got a quarterly statement and that was the communication. Obviously today, I would say most plans have, instantaneous availability by participant. So the products out there have certainly come a long way to be able to support this type of a level of enforcement too.
Yes, that's very true. I sold my first plan to an automobile dealership in 1982, and it was very, very different. It was a participant-directed plan, but it was very, very different than the plan today. And we only gave quarterly statements. There was only the annual updates on the plan. So you're absolutely right. The complexity of the investments, and I think we had 4 or 5 investments in the plan. That was it. The complexity of what's available in plans today and the speed of information has changed everything. And I think that's really what's driving the Department of Labor saying there is the ability now to get information out almost instantaneously, but we have never brought things up to the realm of what we thought back in 1974 when we wrote the code. So I think that's really what their focus is getting this. And again, the key from our presentation that we picked up from their presentation is that word transparency. There is no transparency now within the retirement plan industry. Well, I shouldn't say none, but there's little transparency, and they want to interject transparency into the industry.
What is, I'll save this question till the end.
Okay. Okay. Oh, great. Okay. Great. Well, the next slide would be our current confusion slide, and if in fact it's coming through, what we will be seeing is the side with belief. I'm going to walk down that because what I really want you to understand is why the Department of Labor again got involved, and they got involved because most of the plan sponsors that they queried believed that they had a fiduciary in place. The fiduciary was liable for all the actions of the plan. They believed that the fees were market-driven and very fair. They believed that the education that was provided, which is part of 404C compliance, was excellent as far as they was of good quality. Their employees were treated well, that the plan met all the DOL standards, and that no liability would reach the owners of the business or the plan sponsor. That was the belief. But in reality, what the Department of Labor has said, and what is the truth, is that most plans, if in fact they had a fiduciary, only had what is known as a directed fiduciary as opposed to a discretionary fiduciary. Significant difference between the two, because a directed fiduciary is someone who is directed by the plan sponsor or by someone within the plan to do something, and as long as they do that, they have comported with their position, but the direction may not be correct, or the direction, even though may be sincere, may be wrong. So the directed fiduciary is only liable for directed actions. the fees may be market-driven. However, the issue of many of the products available today is the fees were baked into the product, so there is no way for the plan sponsor to actually be able to find out whether or not the fees were fair and market-driven. The education may be of good quality. However, in a lot of product that is available today, the education is directly related to the product itself as opposed to the education the Department of Labor wants, which is more generic education. So therefore, the employees may be treated well, but they may not be getting what they should be getting according to the Department of Labor. And the plan may meet DOL standards, but there's a possibility that because of the way the product's designed, that it may not meet DOL standards. And therefore, the liability may very well reach all the way up to the plan sponsor and to the owners. So that was the reason for these issues. Now, what I'm going to do now is I'm going to turn things back over to Patty, who's going to be talking about resolution and the summation, and then we'll kind of close. And if there are questions, we'll be happy to answer those as they may pop up. Great.
Okay. Thank you, Dave. All right. There are 3 options for resolving this situation. As business owners, we clearly understand problem resolution. We either change the rules, ignore the rules, or obey the rules. If you change the rules, then you lobby your congressman, and that takes a lot of time, a lot of money, and chances are nothing will happen, nothing will change. You can ignore the rules, which means potential lawsuits from your employees or fines from the Department of Labor. You can also obey the rules by engaging the right vendor in a bundled or unbundled plan. Second, meet the disclosures head-on. April 1st is fast approaching. Determine the potential issues, and right now, the sooner the better, by getting a checkup or a second opinion on your current plan. And put in place a transparent plan now, not later. Regardless of your decision, make sure that you communicate well and often to your employees. From our perspective, third, meet potential liability issues head on. May 1st is the compliance date to ensure the participants are fully informed, and then, of course, choose a resolution that is best for you. From our perspective, retaining a qualified discretionary fiduciary helps bring all of these elements together. So in conclusion, the new rules put in place by the Department of Labor create new opportunities to reduce the plan costs, therefore improve the plan performance. However, these new rules create new liabilities for you as the plan sponsor. The key dates again are service provider fee disclosure, April 1st. Participant fee disclosure, May 31st. The Department of Labor, their new buzzword is transparency. The plan sponsor is always first in responsibility and always has the liability. The plan sponsor may delegate some fiduciary responsibilities, but it's really important to understand that delegation in of itself is a fiduciary act. So what we learned from the Department of Labor is that the process of delegation is key to managing liability. And as a plan sponsor, document the planned and executed process that you go through in selecting the fiduciary, and retain discretionary fiduciary to manage all other areas.
A couple of words in there that you used the term discretionary fiduciary and directed fiduciary. Go back and, Dave, if you will, kind of explain the difference in what each of those defines.
Sure. There are 2 separate sections of the Section 321 fiduciary is a directed fiduciary, and a directed fiduciary has limited liability. It's also known as a limited liability fiduciary. They have limited liability in what they do as far as the plan is concerned. Typically, they would be someone that would be a they would be doing a certain portion of administering the plan. They might provide the investments in the plan. They might be an investment advisor within the plan, but they're not putting the whole plan together. They're not choosing the investments. Typically, what the plan sponsor often doesn't realize is when they have a limited fiduciary, they themselves, even though they're offered a portfolio of investments under the terms of the limited fiduciary, they themselves are making the investment choice. The discretionary fiduciary, however, is the party that picks the investments. They make the decision as to what are offered to the employees, and they make the choices. So the plan sponsor is not liable for that. The plan sponsor is liable for picking the correct discretionary fiduciary, but after that, that discretionary fiduciary chooses the administrative services company, the investments. They make all the other internal choices. So they take the responsibility and the liability for the education, for picking the funds, for monitoring the funds, for finding out whether the funds are meeting their objectives. If they're not, replacing the funds with a fund that does, or monitoring and making sure that the plan administrator is doing its job. So they're taking a lot of liability off the plate of the plan sponsor. That's the difference between the two types of fiduciary.
Okay, to relate that to my experience, we had a 401k fund where the company I worked at, and we hired a bank to be the record keeper, and they generated and took care of all of the transactions. We sent them the money on a weekly or biweekly or monthly basis, whatever that was. They allocated that money to the right participant account. They received data and information from the investment opportunities, or the investment companies that we had designated, and they allocated, kept track of it by participant. So they were, in essence, a directed fiduciary because we hired them to do a specific task.
Yes.
We then went out as the plan sponsor and hired actually a couple of the investment options from that bank that we used at the time. We had probably 5 or 6 other options that we used at that time. And at the end of the quarter, it was our job, that we viewed our job, to provide our employees and our plan participants what's their investment performance from this fund, that fund, and A, B, C, D, all the way down the road, and what's been their success over the last 10 years, 5 years, 1 year, whatever it was. Now, those investment options at that time, under that scenario, they were also directed fiduciaries.
That's correct.
But what I hear you telling me now is that under that scenario, the plan sponsor, you've accepted a lot of liability if you choose to manage your 401k fund like that. What you need to do is to hire the right discretionary fiduciary that will take care of everything, including the investments, the investment option, employee education, employee communication, record keeping. Gotcha.
That's correct.
That's correct, because the liability that you've assumed there is the things that you delineated, but there are a number of other liabilities. For instance, did you have in place a plan to every quarter take a look at the performance of the fund vis-a-vis what it should have been? Did you understand the fees that were taken out of the fund? That's one of the issues that the Department of Labor said, is you may not have been able to understand the fees.
You're exactly right.
Because you didn't know what the fees were.
Right.
But the issue is, ignorance is never an answer under the law. So just because you didn't know what the fees were doesn't mean you're off the hook. So that's really what the DOL is saying here is, we need transparency, because they're not saying that you're wrong in taking that choice. But what they're saying is, you're buying a lot of liability that you may not realize that you're buying. You may not want that liability once you understand what it is. If you don't want the liability, then our recommendation is that you go with a discretionary fiduciary.
And hire that person and
Hire-
shifts that responsibility.
Right. You have liability for choosing the right discretionary fiduciary, but you have managed to then lay off all of the other resulting liabilities that you originally were taking within the plan.
Okay.
That's correct.
But with that in mind, even if I hire a discretionary fiduciary at this point in time, I still need to make sure that they are giving us all that transparent, all the information that is supposed to be transparent. Fees.
Yes.
Okay.
Absolutely.
And if
Absolutely.
they're not-
It's always back on. It always, as the DOL said, it always rolls back to the plan sponsor. What has happened in the industry is the belief that the plan sponsor can somehow lay off completely all of their fiduciary liability and it's on someone else's back.
Mm-hmm.
That's not true.
Okay. Now, the reporting vehicles for all of this, obviously you have your 5500s that are responsible. You have your summary plan descriptions that need to go. And I'm assuming, do the new rules and regulations talk about how that is to be disclosed within those vehicles or within those documents?
They don't give specific information. The 5500 form right now has a cutoff point with 100 participants below and above 100 participants. Above 100 participants, there's much more detailed information on a 5500 than there is below. There's not been any discussion as of yet on changes in the 5500 nor in summary plan description. So I can't really comment on that. There may be other changes the DOL will bring on down the road if these things don't bring about the transparency that they're trying to establish.
Mm-hmm. Where do you see the 401k or the employee retirement? Do you see that the DOL type of requirements? Do you see this as becoming another roadblock to employers saying, "Whoa, wait a minute, maybe we don't even want to be involved in this"?
I think that's an argument that some of the product manufacturers are putting out there, and they're saying that. There have been companies that have done transparent plans for years and years and years. Our bank is not an advertisement, but we are one of several banks that are doing fully transparent discretionary plans. So they've been out there. I think that's a kind of a self-serving comment. Some of the plan sponsors are saying that because they're trying to get the Department of Labor to ease up on the regulations. When you bake fees in and no one can figure out what it's really costing someone, it's always easy to say, well, if you make this thing transparent and we have to go through all this stuff, business owners may not want to. It's always been able for a business owner to retain a discretionary fiduciary, let them make the decisions, let them choose the funds, and build a plan that meets the requirements of the business owner and of his employees. A point that I would make to most business owners is oftentimes in smaller plans, the business owner is a substantial owner in the plan. So this actually benefits them by reduced costs because it improves their personal return as well as the return of their employees. So I don't think that if they really take a long, hard look at this, I don't think there's any reason for businesses not to get involved or to say, I don't want to provide a 401k.
And I do believe, I mean, my experience has been that most employers want to do the right thing. And
I would agree.
And they want to provide their employees with a path towards a decent retirement. And that we all know that if you don't do anything, people will they just won't do it on their own. I mean, it's just it's just the nature of human beings, I suppose.
Unfortunately, that's true. I think all of us in this room are in agreement on that. Yes.
So I do believe that most people are looking towards, okay, how can I comply and how can I provide the best product, but yet at the same time I want to do it in a cost-effective manner for my employees and the plan participants.
Absolutely, and I think what's going to be surprising to many of the plan sponsors out there is the fact that they have been paying a lot more for the plan than they realize. And when I say paying, they're paying it in reduced returns to themselves and to their employees. And so I think the value of what the Department of Labor is doing is saying, if there are fees, they must be disclosed. They cannot be baked in anymore. They can't be hidden inside of a product. They have to be out where people can see them, so that now a business owner can say, whoa, wait a minute, I don't think I need to be paying that kind of fee. I think there's a better opportunity, there's a better plan out there for my employees and for myself as well.
Where do you see this issue? Or obviously we're presenting the issue today for our clients and friends to say, hey, this is something you have to look at. Where do you see this on the radar of most business people? Do you see that it's something that is not getting pushed out there, whether it be through trade organizations, whether it be through their professional providers?
Unfortunately, I think that's true. There was the most recent survey done by one of the larger accounting firms said that well past 60% of the people that they surveyed had no knowledge or understanding of what these DOL regulations were, and felt very uncomfortable with whatever they did know about them. I think part of the issue is that the service providers are finding themselves in a catch-22. They've baked fees in, they've charged fees that may or may not be equitable based on a marketplace, and now suddenly they're going to be forced to provide this information out to businesses. So I think that they've drugged their feet in getting this information out. I think business owners have also somewhat of a culpability, but maybe they're to be excused for this. Their belief, as the DOL has shown, their belief is that by having these so-called fiduciaries in place, they don't have any liability. So the Department of Labor has been sending information out to plan sponsors now for a while. But if I were a business owner and I'm busy trying to keep my business afloat in today's economy, and I see something directed to the fiduciary, and I say, well, doggone it, I've got a fiduciary, so this is really not in my wheelhouse. So I think that that's oftentimes what's happened. I think it's a sad set of circumstances that we have, and that's really the purpose for what we're trying to do today, Jack, is to remedy that, get the word out to people, say this is coming, and there are significant issues involved with this. So, appreciate the opportunity from Battelle to provide this information to your clients.
I guess as we look to wrap up, any final words of wisdom to get started? It's something that they need to. That if you have a 401k, if you have a retirement plan, it's an issue that you need to talk to your current service provider, making sure you comply. If you don't, start out there looking and
get a second opinion.
Get a second opinion and learn more about it. And I'm sure, certainly, I learned a lot more today.
Well, good. And we're obviously out there to offer a second opinion, but we will provide the opinion to you and tell you if you do have a good plan, and we oftentimes find there are good quality plans out there. This is certainly not an indictment over everybody in the industry, but there are really good companies and quality plans out there. Our goal is to help you understand that this is a problem coming down the pike, rather than find out on April 2nd that you need to be in compliance, or on June 1st that you're out of compliance. Now's the time to really start looking at these things.
What I remember when ERISA came in, not that gives my age or anything like that, but I remember that it took a long time for substantial compliance to gain traction. I would expect that a change like this is going to be much quicker. They're going to people are going to adjust to it on a much quicker basis than they used to.
I think they will, Jack, because I think, again, we're in an information fast information world, and if you think about it, I share that same thing. I remember when ERISA came into place. I was in business myself, so I think you and I are dating each other. But we didn't have the fast information. We got information out on a quarterly basis, and people would just look at things. Now there's such a preponderance of information, and it's a constant drumbeat about what's happening as far as financials and things like that. So I think that the compliance will be extremely fast comparative to what we had back in the mid-'70s when ERISA really started out.
Yeah, you're right. Information is much more readily available today. Than
Good news and bad news are both
out there.
Yeah.
Oh, great.
Yeah.
Before we end today, I want to make sure I get the third CPE code, and that code is 952. 952. So with that, I want to thank Patty and Dave. Thanks for coming in and spending your time.
Thank you.
Hopefully it was beneficial to everybody that listened in. And again, I wish everybody a good afternoon, and thanks again for listening in. Take care.
Bye-bye.
Bye-bye.